Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA, and my guest today is Bill Mahan, an attorney here in Campbell, California. And today we're going to be talking about the tax considerations for short sales and foreclosures. So, here we go again. This one is going to be a challenging one for us to talk about in a half an hour. And again, I'm a tax consultant, so we may have a little bit more of a conversation related to some of these points. And we also want to caution you again, though, each situation really is different. And so you need to see a tax consultant when you're dealing with one of these. This is just to give you some information as a starting point. Okay, so with that, let's get started. So Bill, let's start with a little bit, again, related to loan modifications, because we're hoping that people will be able to do that instead of having to go through the short sale and foreclosure. What happens when you have a loan modification from a tax point of view?
Right. From the tax standpoint, assuming you're able to negotiate a modification of your loan, then my understanding of the tax consequences is there can be tax consequences, but it depends on what kind of a modification you actually are able to negotiate. Mm-hmm. So the ways that you can get a mortgage payment down or keep it down would be things like negotiating with the lender to maybe not adjust the adjustable rate up when they're supposed to. Mm-hmm. Like there are trigger points and the rates go up, well, you might be able to negotiate so that they don't do that, so you can continue to make a lower mortgage payment and continue to keep the property that way. You also might adjust the term of the loan, how many years the loan is for, and that might bring down the monthly mortgage payment somewhat. Mm-hmm. The other thing that's possible, though, is to modify the principal amount that's owed. And if you do that, or any combination of these things where you in some part reduce the principal amount that's owed, then there is probably going to be an income tax consequence to that, because in these kinds of transactions with residential property, again we're talking primarily residential property in this conversation, there are two main ways that you have income tax exposure. One is in the capital gain or loss category, which is from the sale itself. Mm-hmm. That won't apply in a modification, obviously. But the other type of income that's possible is what's called cancellation of debt income, or COD income. Mm-hmm. And when you have part of your principal balance forgiven by a lender, they are in effect forgiving part of the debt, and therefore that would give rise to cancellation of debt income. And this is in the context of a loan modification, so it's a little bit different than in a foreclosure context or whatever. But it seems to me it may still qualify under some of the relief statutes that are out there as far as not taxing debt relief income in a primary residence. So again, we have to think about what kind of residence is this? Is it a personal residence of the borrower? And what kind of a modification did they get to decide whether or not there were tax consequences?
Okay, so we're going to get a little bit into that in more detail a little later, but we do need to know, again, this is cancellation of debt, and so there can be a tax consequence and at least something to deal with on your tax return, because the lender is going to issue an information return to the borrower to the effect that some debt has been canceled, in some of these cases, again, especially with the principal write-downs. And so they need to be alert for that, and it has to be dealt with your tax return, even though there may not be taxable income. Right. They still have at least a disclosure item.
It's going to be a reportable item.
Yeah. All right. So now, in our last show, we talked a little bit about recourse and non-recourse. Some of our viewers for today may not have seen that. So I'll just say, why don't we refresh our memory for a few moments and talk a little bit about what is recourse and what is non-recourse and what's the difference?
Okay, well, again, there are different kinds of what we call non-recourse debt. Recourse debt is when you borrow money, and if the property is sold or transferred back, 'for' for less than the amount of the debt, then the borrower whether it's just a first mortgage or a first, second, third, whatever the mortgages are. If it's less than the amount of the debt and it's recourse debt, then the lenders can pursue the borrower for the difference between what the property was worth when it was transferred and what the debt is. And so if that happens, we don't have an income tax issue about the cancellation of debt income, because if they collect all the debt, you've got a liability issue.
Yeah, right.
Non-recourse debt arises in two ways. One is through negotiation, where the document itself identifies it as non-recourse debt, and the other is under anti-deficiency statutes of some of the states. There are 12 states that have anti-deficiency statutes. They're all different. Some of them may be the same, but the ones I've seen are different. So you have to go state by state and read the statute to see if the kind of borrowing that you have is non-recourse. Generally, it applies to personal residences. There might be restrictions as to how many units it can be. It can usually be, in California, it can be between 1 and 4 units, as long as the borrower intends to occupy one of the units. And therefore, the type of debt that it is depends on all these circumstances.
Yes.
And it has a significant consequence in terms of the tax liability that you might owe, depending on these different types of things that can happen that we're going to talk about.
Okay. And again, we want to emphasize here that the rules for the various states related to this may be different. Some states don't even have anti-deficiency statutes.
Most of the states don't have them. There are 12 states that do, so obviously that's 38 states, if my math is right, that don't have them. There are other things that some states have that are called one form of action rules. There are some things that apply to properties that might limit your exposure to liability. But it's a state-by-state analysis, so depending on where the property is, you'd have to have that investigated.
Yeah. I don't think we talked that much last time about this one form of action rule. Maybe we should just talk about it for just a moment. And so the point is, first of all, that as we said before, you can't tell by looking at a mortgage whether it's recourse or non-recourse. And even if it is recourse, if the trustee elects to exercise its right under a deed of trust to take the property back, then that can still stop personal liability, as I understand it. Is that right?
Yeah, there again are going to be different types of one form of action rules, so you have to look at it at a state-by-state level. But in California, basically, for example, if a lender decides to exercise the sale under deed of trust, which is what they're almost always going to do, then the statute prevents them from seeking a deficiency for any mortgage that's above and beyond what the property is worth when they do that. So that's a type of one form of action rule where they are limited to that. The little bit of caveat there is, again, when you have second and third mortgages, those loans are wiped out, but they're not, the security is wiped out, but the loans are still loans. And so the borrower can still owe money to those second and third mortgage holders. And even though the collateral is no longer there, they might still have some recourse against the borrower through a lawsuit under the note. So in other words, the one form of action that the lender that exercised the trustee sale, their one form of action doesn't necessarily eliminate other people.
Okay, but now related to California's anti-deficiency statute or whatever, again, on the second or third mortgages, if they were originated when you bought the property,
purchase money,
in that case, you still have some protection.
You do have protection in that case, because this is why the type of financing is important. If it's purchase money, meaning that it was a first or a second or even a third, but it was part of the original purchase money or the property, and it's a property that qualifies otherwise under the statute, then the second and third holders would also not have any recourse against you